Well, hi everyone, Shaun Humphries here. Welcome to All Things Retirement. Well, in this video, we're going to talk about you'll win more by losing less. And so one of the key principles around investing is to manage and monitor potential investment volatility risk on your portfolio. And this particular discussion is going to really underscore the importance of that strategy when building your portfolio, particularly for retirement, where you're worrying about sequence of return risk and market volatility as you're taking income out of your portfolio. So we're going to talk about winning more by losing less in this video. Now, if you're new to the channel, make sure you hit subscribe so you don't miss future content that we're posting on a regular basis. If you're interested in finding out how you can get a complimentary retirement income plan, go to the show notes. There's a link back to our website that gives you more information on that. Plus, we have some complimentary retirement income planning resources that you can access as well. So make sure you visit the show notes for this video. Okay, winning more by losing less. Let's take a look at the numbers. So BlackRock put together this slide deck to illustrate the impact of market volatility on your portfolio. When your market goes down, it has to work that much harder to get back to where it was and then grow from that point on. Let's take a look at the chart. So they invested $100,000 in the S&P 500, which is the U.S. stock market, just before the financial crisis in 2009. By the time they got to December 31st, 2023, the portfolio grew to $422,060. Okay, so they said, well, if you invested slightly different to reduce the short-term volatility, what was the impact? And so they made the comment, I guess this is a common refrain within BlackRock, as we like to say, 3/4 of the up and 3/4 of the down got you all the way up with only 3/4 of the way down. In simpler terms, the portfolio captured the same returns or possibly better, but with less volatility. So you could actually build a portfolio that fluctuated less, but got you to the same endpoint through this period of market volatility. So it gets back to the whole discussion on asset allocation and the mix of investments. So if you look at all the way up and all the way down, this is the S&P 500, you can see that the $100,000 was invested, and then we saw a downturn in the market, minus 55%. So it went from $100,000 to $44,750. Ouch, that's pretty painful. We then saw a rally in the market to the tune of 528%, almost 529%. The portfolio now is up to $281,424. The market then went down again, and this downturn happened in 2020. It was down 33%, down to 186,330. We then saw an increase of 120% to a peak. That's in the early part of 2022. Portfolio grew to $410,000 in portfolio value. We then saw a downturn in the markets to the tune of 18.6%. So the 410 went down to 334, and then we saw an increase of 26% from the end of 2022 to the end of 2023. So the portfolio landed at 422. Now, what this chart here illustrates is the 3/4 down. So you might have a portfolio that has both equities, mostly equities, but with some fixed income, maybe some cash. So the portfolio went down by 41%, so 3/4 of the way down to 58,563. We then saw a rally of 396, whereas the other portfolio, which was 100% invested in the markets, at 528. We saw then a decline of 25.3 as opposed to 33.8. And then we saw the portfolio rally again, up 90% to 413, then a decline of 14%, then an increase of 19.7. It was slightly larger. So we saw less volatility, a quarter less of the volatility. So it didn't get all the upside, but it didn't get all the downside in the portfolio. So the main idea here is to illustrate the impact of recovering from losses. So let's look at the math. I mean, I think we often forget just how difficult it is to recover from losses in the portfolio. That's why when you're trying to squeeze out additional return, you need to be very clear-eyed about what you need to get as gains if you do experience some losses. So you look at the math, the greater the loss, the harder it is to break even. I think we all know that intuitively. However, if you've got $1 in your portfolio, it drops by 50%, it's now worth 50 cents. How do you get back up to that buck? You need to get 100% return. So that initial 50% return has to translate to 100% return on the 50 cents to get back to break even. This is a helpful chart. It's got the return needed to break even and the investment loss. And so if I had a loss in my portfolio, let's say of 20%, I would need to get a 25% return to break even. If I had a loss in my portfolio of 30%, I would need to get 43% return to break even. And if I had a loss of 50%, I obviously need to get 100% return to break even. So the big takeaway here is when you construct portfolios, make sure you quantify the risk on that portfolio as best you can, and don't take on more risk than is necessary to achieve your goals. We have other videos that talk about how you can manage risk in the short term so you don't have to sell assets at an inopportune time. So if you do see a downturn, you can allow that portfolio to ride upward momentum. Let me just show you one more chart that really is a good example of what I'm talking about. So this chart really illustrates what I'm getting at, the management of risk and reward in portfolios. So this portfolio in the white here, whitish color, is a balanced portfolio made up of 40% fixed income, 60% stocks. What the chart's showing you is from year 2000 right through to 2021, it's giving you the returns of each of the major investment categories that could be used to build a portfolio. Canadian equity large cap, Canadian small cap, U.S. equity large cap, U.S. small cap, international equity, emerging markets, global real estate, Canadian fixed income, global fixed income, high yield, income, and then the balanced portfolio, which is in the whitish kind of color here. So on the stock side, for most of these investment categories, you see quite a bit of volatility. Some years awesome returns, some years mediocre returns, some years losses. You can see at the end of this time period, the best performing asset class was U.S. large cap stocks. The white here is the balanced portfolio. And what you see, what's quite noticeable, is it doesn't fluctuate dramatically year by year. There's a tighter range of return. This is important because the other reason we want to manage that risk is if you're taking income, or even from an emotional psychological standpoint, if there's too much volatility in your portfolio, even though intellectually you know you have to get some better returns on part of your portfolio, you might bail on the strategy if there's too much volatility. So at the end of this period of time, the 10-year average was such that, of course, U.S. large cap stocks had the best return at 17.7%. The balanced portfolio had the fourth best return at 9.1%. And let's just assume that the client didn't need much more than 9 to 10% returns to achieve the retirement goals. They were able to construct a portfolio that has more moderate risk than the other asset classes. 9.1 was the fourth best return. 10-year volatility, percentage-wise, 7.2 is the third lowest portfolio or a security mix from a volatility standpoint. This is called getting your cake and eating it too. Decent returns, aligned up with the retirement goals, and reduced risk on the portfolio. Okay, so that's the basic overview on trying to manage downside. You want to take on sufficient risk to achieve your goals so you can cope with taxes and inflationary pressures over time, but don't take on more risk than necessary. Hope that's helpful for you. Again, if you haven't subscribed to our channel, make sure you do that. And if you want to find out how you can get a complimentary retirement income plan, there's a link in the show notes to take you back to our website where you can get more information about that service. Anyway, wishing you all the best in your retirement and overall wealth planning journey. You take care. Bye-bye.